Welcome. Today, we're learning about anti-money laundering, focusing on structuring and currency transaction reports. It's also known as CTRs. Both are key tools that financial institutions use to prevent money laundering. First, structuring, also called smurfing, happens when someone breaks up a large cash deposit into smaller amounts under $10,000 to avoid reporting requirements. Structuring is one of the most common methods of money laundering. Let's look at an example of this. Here we have a simplified view of Mr. Launder's cash-in and cash-out totals through a 5-day period. On Tuesday, Wednesday, and Thursday, Mr. Launders withdrew cash just below the CTR threshold. This can seem like structuring since the dates of withdrawal were one business day apart, each showing us that Mr. Launders may have been trying to avoid the CTR filing threshold. If Mr. Launders deposits cash below the threshold on Monday and Wednesday, as shown here, it should not be assumed he is trying to structure funds. Further review and research from the AML team would be done utilizing various factors to determine whether suspicious activity has occurred. Be aware that cash can also be used to purchase or cash out monetary instruments for structuring. Mr. Launders can purchase bank checks, money orders, or conduct currency exchanges in amounts below the filing threshold. Now add this simplified scenario to a large business, it becomes more complex. Larger scale of structuring and money laundering can occur. Why is this important, you may ask? When a customer deposits or withdraws $10,000 or more in cash, financial institutions in the U.S. are required to file a currency transaction report, or CTR. But wait, where did this rule come from? Why does it matter to anyone not working in anti-money laundering? This begins with the Bank Secrecy Act, BSA, passed in 1970 at the time. The U.S. government was becoming increasingly concerned about organized crime, tax evasion, and hidden offshore accounts. Law enforcement agencies were struggling to follow the money. Criminal organizations were moving large amounts of cash through banks with little oversight. So Congress created the Bank Secrecy Act to require financial institutions to keep certain records and report large cash transactions to the government. That's where the $10,000 threshold comes from. Any single cash transaction over $10,000 or multiple cash transactions totaling more than $10,000 in one business day triggers a CTR filing. The goal was not to accuse customers of wrongdoing. Instead, it created a paper trail which helped identify patterns tied to trafficking, organized crime, corruption, and terrorism financing. After the attacks of September 11, 2001, reporting requirements became even more important. The USA Patriot Act strengthened anti-money laundering laws and expanded monitoring requirements to detect terrorist financing. Airports are major points of entry and exit for physical currency. While financial institutions file CTRs for large cash transactions, travelers entering or leaving the United States must report if they are physically carrying more than $10,000 in monetary instruments. This requirement is enforced by U.S. Customs and Border Protection under federal law. Remember, filing a CTR does not automatically mean someone is in trouble. It simply means the transaction met a reporting threshold established by law. So the next time you visit your bank or head out of the United States for vacation, you'll understand why that information is collected. It isn't about inconvenience. It's about transparency. These reporting requirements are powerful tools used to prevent money laundering and protect the financial system. If you found this video helpful, make sure to subscribe for more content.